Welcome to episode 69 of the Cashflow Connections podcast. Our topic for today is macroeconomic outlook from a former IMF consultant. Let me ask you something before we even get started. How long has it been since I've really taken the time to thank you for your listenership? I'm not sure, but it's been too long, and I'll tell you why. About 10 years ago, I read a book called The Corruption of Capitalism, and I really enjoyed it. I learned a lot, definitely formed a little bit of my perspective when I was coming into the world of being an entrepreneur and investing in particular. But I'll tell you how much my life has changed since that about 10 years ago. Now, if I pick up a book read by the exact same author, I can literally reach out to them, tell them who I am, tell them about the program, tell them a little about you as listeners, and now we can have an awesome conversation. And that's exactly what this conversation is all about. He is the author of that book and many others, which we'll talk about on the show as well. So we're going to get into a lot of really awesome stuff. This guy is incredibly intelligent, and the conversation is really something special. Definitely one of those ones you're going to want to listen to over and over again. So the first thing we talk about is about 25 or 30 minutes just about interest rates. This is our guest's number one most important metric to pay attention to. And I really like the level of detail on this one particular aspect of the market because it's likely the single most important determiner of the oncoming economic correction. Interest rates are the most important determiner of financial assets as a whole because debt is such a critical portion of the economy and of real estate in particular. But this level of detail, this level of understanding is really hard to come by. Then we talk about China and the trade war and how this may impact the economy and eventually the housing market itself. And of course, if we're talking about macroeconomics, you know that we're going to talk about probably my favorite topic to bring up, which is Japan and the 30-year economic challenges that they've been having. Are you guys sick of hearing about Japan yet? Too bad if you are, because I'm fascinated by this topic. And it's actually interesting because our guest has a different perspective on this topic than I do. And I want to learn more. So, it's an interesting conversation to have. Then at the end, we get into our guest's suggested cures for a lot of the challenges that the U.S. is facing regarding debt and deficits and interest rates. Now, I know that a lot of you are proponents of the Austrian School of Economics. And I also know that you've probably heard me drop some libertarian-friendly perspectives pretty frequently on the show. So before you listen to the last part of this portion, I want to let you know, make it clear, that I am a philosophical libertarian and more accurately a narco-capitalist, if we're using the accurate terminology. So I am familiar with the arguments against some of these prescriptions that our guest is talking about. I just don't think it's the time to jump into a full-fledged debate near the end of an hour-long conversation when there is a lot of foundational understandings that I would have to overcome to make that debate fruitful. I'd much rather just learn more about other people's perspectives. That's the reason that I have the show. Now, if you're interested in learning about some of these rebuttals, you can always just Google whatever the question is, Mises. So if someone says that the reason that the Great Depression took 10 years to recover from was because of a lack of government involvement or something to that extent, you can Google, why did the U.S. take so long to recover from the Great Depression? Mises, that's M-I-S-E-S. Or, more poignantly, the Forgotten Depression of 1921. Now, I'm saying all of this because I don't want to lose my street credit. But like I said, I'm familiar with a lot of these arguments, but now's not the time to get into that. And I don't think our guests would have a problem with me mentioning that on the show. Also, if you may remember, we recently did a little bit of a competition based on reviews for the Cashflow Connections podcast. We kind of had a raffle. So guess what? We've established a winner. The winner is RadCrowd, R-A-D-C-R-O-W-D. That is not his given name, but that is his screen name on iTunes. So you are the winner. So make sure to email me at info@cashflowconnections.com, RadCrowd, to get your free Cashflow Connections t-shirt. I really appreciate the support. He wrote, awesome podcast with great guests. I'm a passive investor, and the ideas presented by Hunter have really helped me in my investment journey. Well, I can't thank you enough for the kind words, and I'm very glad to hear it. If you agree with RadCrowd and the program has helped you out, don't forget to leave a review in iTunes. It makes a huge difference in terms of the show's visibility, and it's pretty funny. I met a lot of people at the Intelligent Investors Real Estate Conference, and they listen to the show, and they like the show a lot, and they'll come up and they'll say, dude, I love your program so much. I can't thank you enough. I've learned so much. I still need to leave a review though. I'm like, come on, don't withhold that from me. It's a free show. It's free to leave a review. It probably takes 20 seconds. Just scroll to the bottom of the show, search Cashflow Connections Podcast in the podcast app, scroll to the bottom and say, good show, good guess. Hunter is incredibly handsome, 5 stars. That's all you got to do. And you have a good life from then on out. All right. Hope you enjoyed the episode. How's it going, everyone? Our guest for today is Richard Duncan, who is the author of 3 books on the global economic crisis, including the international bestseller, The Dollar Crisis, Causes, Consequences, Cures, which forecasted the global economic crisis of 2008 with extraordinary accuracy. Richard started his career as an equity analyst, later worked as a financial sector specialist for the World Bank in D.C. He headed equity research for departments for companies like Salomon Brothers, and later worked as a consultant for the IMF during the Asia crisis. He's now a publisher of the video newsletter, which is MacroWatch, which can be found on his website, richardduncaneconomics.com. So I got to tell you, Richard, I'm really happy to have you on, and your books, especially The Corruption of Capitalism, was one of the first books I read on these topics. So really an honor, and thanks again for taking the time.
Thank you, Hunter. It's a pleasure to be on your show.
So there's a million different topics that I want to get into, and this is really an interesting conversation, especially for this particular podcast. But I really want to start out with something that I think almost everyone wants to know from most economists that they look up to and are interested in, which is, what's your current level of concern, especially about the U.S. economy, the U.S. real estate market? Where do you think we are on that fear index from your particular perspective?
Well, so everything depends on where interest rates are going to go in the future. And it looks like interest rates could move significantly higher. So my concern is quite high. I'm very concerned interest rates are going to move higher for a number of reasons. And if they do, then that could cause a very serious correction in asset prices and a very severe recession.
Fair enough. And just to kind of expand on that, what is your outlook on the current state of interest rates? What are you seeing in terms of what would be causing that interest rate increase to take place?
So interest rates are so key for a number of reasons. If we look back to the early 1980s, the 10-year government bond yield was roughly 15%. And as it came down year after year, hitting a low of something like 1.6% a year or two ago, it made credit more affordable for Americans. So the Americans borrowed more and spent more. And as they did, that borrowing and spending drove the economic growth. So it was credit growth that drove economic growth. And at the same time, as interest rates came down, then property prices went up and stock prices went up. So there's a real danger now that if interest rates start moving higher, then not only will that make borrowing more expensive, making it too expensive for Americans to borrow and spend, credit would contract, and that would cause a severe recession in the U.S. by itself. But on top of that, if interest rates go higher, then asset prices will also fall sharply. And that too would cause a severe recession. So it would be a double recession if interest rates move up very much further from here. And there are a number of reasons to worry that they will. Let me go through the list. First of all, of course, everyone is aware that the Fed is tightening at the short end, tightening the federal funds rate. They have been gradually moving up the federal funds rate, now starting back at the end of 2015. They're expected to hike again in December and perhaps as much as 3 more times next year. But that's not my greatest concern about the Fed. In my opinion, where they are really tightening is through quantitative tightening. Everyone is familiar with the term quantitative easing. When the crisis began, the Fed started creating money from thin air and using it to buy bonds, mostly government bonds, but also bonds issued or guaranteed by Fannie Mae and Freddie Mac. And they did that in 3 rounds of quantitative easing, creating something like $3.5 trillion from thin air and buying $3.5 trillion worth of bonds. Well, of course, that pushed up the bond prices and that pushed down interest rates. And every time they had a round of quantitative easing, that pushed up the stock market. So now they are doing the exact opposite. Starting in October last year, instead of creating money and buying assets, they are, to make things a bit simple, they are effectively destroying dollars and selling assets. or selling bonds, which destroys dollars. So instead of creating money and buying assets, they are now destroying money and selling assets. And they started off gradually at $10 billion a month for the first quarter, which was the fourth quarter of last year. And then they have moved it up to $20 billion a month in the first quarter of this year, then $30 billion a month in the second quarter, $40 billion a month in the third quarter. And as of October, they've started destroying $50 billion every month and sucking $50 billion out of the financial markets. So this is how they are really tightening up the environment for money. Of course, the more money there is, the cheaper it is. But when the Fed destroys money, it becomes more scarce and it pushes up interest rates. So that's a real concern. And the Fed intends to continue doing this potentially for the next couple of years, which will destroy more than $1 trillion over the next couple of years. So that's the biggest concern.
Okay, interesting. And so I want to circle back on that. So can you explain how the Fed selling bonds is effectively destroying money? Because I can imagine the bonds are basically an IOU. So the Fed owns them, they created them and then own them themselves. But how does selling them destroy that currency essentially, or remove it from circulation, for example?
Okay, yes. So let me explain by first explaining how the Fed creates money. A central bank can create money in one of two ways. First, they can either have money printed, physical currency printed, but more frequently, what they do is every bank has an account at the Fed. And so when the Fed creates money, for instance, when they were doing quantitative easing, they bought government bonds. And to pay for those bonds, they simply made a deposit into the account that banks hold at the Fed. That's how they created money. The act of making the deposit created the money.
Right.
Okay, so now what's happening? Up until a year ago, every time one of the bonds that they owned matured, they took the cash and reinvested it in a similar bond. In other words, they just rolled over their holding, their bond portfolio. But as of October last year, they started allowing some of those bonds to mature without rolling them over. So they just took the cash instead of taking the cash and buying another bond. So what that meant was that the government had to find some other buyer to buy those bonds. Since the Fed wasn't buying them anymore, someone in the private sector had to buy them. Now, so when the Fed takes the cash, it's the opposite of them making a deposit into the account of a bank. The Fed takes the cash and effectively, instead of making a deposit, it removes the deposit from the bank's account.
Understood.
By shrinking those accounts, that's how the Fed destroys money. So people often talk about the Fed creating money, but they don't understand the technicalities behind it. So this is how the Fed is destroying money. When these bonds mature now, roughly $50 billion a month, as those bonds mature, then the Fed doesn't roll them over. Instead, it takes the cash. And when the Fed takes the cash just evaporates. It's not like the Fed has a big vault somewhere full of dollar bills.
Right.
It just takes it out of the bank's accounts. And so there is less cash in the bank's accounts at the Fed, and therefore there is less money. So that is the Fed destroying money.
Yeah, I appreciate you kind of explaining that. I think a lot of people are going to be interested in kind of looking at that because it is truly the way that you say it. You do hear people frequently say, well, the Fed is creating money out of thin air, but there is the opposite of that, which is that, removing it from the banks to the balance sheet is essentially what's going on. You mentioned about $50 billion per month. To put that in perspective, how significant is that in terms of the overall amount of money supply out there, and how significant of a role do you think that'll play in, the economy going forward in the next 1 to 5 years?
Okay, so that will, by the end of 2019, the Fed will have shrunk its balance sheet, or in other words, destroyed roughly $1 trillion. And that is roughly a quarter of the Fed's entire balance sheet. So it's very significant. It is a dramatic tightening of the dollar money supply in the world. So this is extreme monetary tightening if it continues. And the financial markets should be terrified of this, and they don't really seem to have paid much attention thus far. But it's like the oxygen is being slowly removed from a room full of people. At first, they barely notice, but after a little while, when it becomes difficult to breathe, then they'll begin running for the exits, I fear.
Interesting. And I think that metaphor is kind of fascinating because, so I think that, you mentioned that the Fed early on during the recession, they went through great lengths to create money, essentially out of thin air. So, what would your response be to people that are sympathetic to the view that these trillions of dollars, 1 trillion isn't enough. It should be 3 trillion or 3.5 trillion, in the sense that the Fed created that much out of thin air. Like, we're trying to get back to the level that would existed. Instead of it being oxygen, it's more of like a heroin type of environment where the heroin's pumped in, and what we need to do is get off that. What are your thoughts on that?
Well, so the Fed has not been giving any doses of heroin now since October 2014. So the drug addict seems to have survived cold turkey. And now what the Fed is doing is pumping the poor person's stomach. It's extreme monetary tightening. Now, what is the point of doing this? Why should they do this? I don't see any reason to do quantitative tightening at all. The big taboo was to create the money in the first place. Central banks are not supposed to create money. Everyone knows that. In the past, when a central bank created a lot of money, it always tended to cause very high rates of inflation or even hyperinflation. So that was why this was such a big taboo. Okay, well, the taboo has been broken a long time ago, starting in the beginning of 2009. And it didn't cause any inflation to speak of, at least at the consumer price level. Why didn't it cause inflation this time? Well, because something entirely new is happening this time that didn't happen in the past, and that's globalization. Globalization is extremely deflationary, because instead of having to hire someone in Detroit, for instance, and paying that person $200 a day to make a car, now it's possible to hire someone in China and pay that person $10 a day to make a car. So this is a 90% drop in the marginal cost of labor. Your next worker costs 95% less than your last worker did. So this is extremely deflationary and is putting downward pressure on wages in the West. It's also putting downward pressure on the cost of all manufactured goods. So this deflationary pressure coming from globalization has completely offset the inflationary pressure that would have arisen through paper money creation by the central banks. And therefore, the central banks managed to get away with an extraordinary amount of money creation, particularly after 2008. So now it's very interesting because the Fed is not alone in doing this. The Fed now owns roughly 11% of all the U.S. government debt through its quantitative easing program. It printed money and bought government bonds, so it now owns 11% of U.S. government debt. And it owns something like another $1.7 trillion of Fannie and Freddie debt. Now, the other central banks have been doing something very similar. The Bank of England and the European Central Bank, those two central banks own roughly 25% of all their government's debt. And the Bank of Japan owns 40% of all Japanese government debt. And in none of these countries has there been any inflation. Now, so this is an extraordinary development. What this means is that these governments have been able to run very large budget deficits, and the Fed or the central banks have helped them finance those large budget deficits. The deficits have stimulated the economy. Normally, borrowing so much money would have pushed up interest rates. But in what we've seen over the last 10 years is that interest rates didn't go up because the central banks printed a lot of money and bought a lot of bonds and either pushed the interest rates lower in most cases, or at least held them down. So this is a new moment, something we have not experienced before. This combination of paper money creation on a multi-trillion-dollar scale with globalization has allowed a policy response to the crisis of 2008 that prevented a Great Depression. Had this not occurred, we would have relived the 1930s. We would have had another Great Depression, because when the debt that was borrowed during the roaring 20s, when all of that debt couldn't be repaid in 1930, the banking system failed. The government didn't know what to do. They did very little. And the banking system collapsed, and international trade collapsed, and unemployment went up to 25% in the US. World trade broke down, and the global economy crashed, and the depression lasted for 10 years and led to World War II. And then, only then, when the government started spending massively to fight the war, did the depression end. This time, we avoided a 10-year depression and potentially World War III, because the governments did, when the bottom started dropping out, when the debt couldn't be repaid by the private sector, the governments took on much more debt, and they financed it with paper money creation. by the central banks. And this prevented the banks from all failing, and it pushed up asset prices, and it made the economy grow again. So that's where we are 10 years down the road. People say we've just been kicking the can down the road. Well, I'm all for it. It's lasted 10 years. I hope they kick it down the road another 30 years. That's going to work for me.
Yeah, that's pretty funny. You have touched on so many things there, and there's just so many routes that we can go. I'm really fascinated by the conversation about interest rates, particularly as the Fed is no longer buying or no longer rolling them over, as new bonds become due. Really the question is, where's the market price for those bonds? Because really the goal is to figure out where interest rates will be. And it looks like if the Fed's going to be doing this tightening, that's where we're going to find out. So do you have an idea of what you're seeing in terms of the demand? I mean, given the global economy, given the fact that so many banks are pursuing this extremely unique monetary strategy, do you see that they're being buyers of U.S. debt at certain price points? And if so, where do those price points end up in interest rates being for the purposes of real estate or otherwise?
Okay, well, so the Fed stopped doing quantitative easing in October 2014, but around that time, the ECB started doing quantitative easing in Europe very aggressively on an even larger scale than the Fed had been doing. But now the ECB is winding down their program. They're still printing money, but this is the last quarter. They intend to print any. At the peak, I believe they were printing 85 billion euros a month. Now they're down to printing 15 billion euros a month. And it's going to end at the end of December. So up until now, as long as the European Central Bank has been printing money and buying European government bonds, that's held down the yield on European government bonds. And you've seen the yields on government bonds in countries like Spain and up until recently, Italy, were even lower than the yields on 10-year U.S. government bonds,
right?
Which is just not right.
Yeah.
So they've been helping to hold down government bond yields in the U.S., as has Japan. The Bank of Japan is still going ahead with its QE program full scale. Essentially, as I mentioned earlier, they've already bought up 40% of all Japanese government debt. Well, now they've got to the point where they've been buying so many government bonds that there really just aren't that many of them left in the market. And it's pushed up the prices to such a point that the Bank of Japan now creates as much money as it needs to keep the Japanese government bond yield at 10 basis points. In other words, 10% of 1%. So Japanese government can essentially borrow money for free for 10 basis points. And that's still continuing. And it's going to continue as far as we know into the foreseeable future. So that's one reason that will help hold U.S. interest rates down. But there are many other reasons that the interest rates in the U.S. are likely to go up. For instance, the government's borrowing much more. After the tax cuts at the end of about a year ago, and then the budget increase in government spending that Congress enacted in February this year, that's going to make the U.S. budget deficit very significantly higher. It looks like it will be more than $1 trillion next year. So the government will have to borrow more. And all other factors being the same, if the government borrows more, that sucks money out of the economy and it leaves less money for other people to borrow, and that pushes up interest rates. Now, the next reason interest rates are likely to go higher. This has to do with money coming from abroad. Every country's balance of payments has to balance. Now, what that means is when a country like the United States has a large trade deficit, as we do, the U.S. current account deficit will soon be about $500 billion. So when a country has a $500 billion current account deficit, it must have and does have a $500 billion capital inflow coming from abroad. Now, it's just like a family. If a family spends more than it earns, then it has to finance that spending one way or the other, either by selling assets or by borrowing. And it's the same for a country. So the point is, when the U.S. has a $500 billion trade deficit, it also has a $500 billion of capital inflow, money coming into the country, primarily buying U.S. government bonds. Now, President Trump has said repeatedly that it is his goal to eliminate the U.S. current account deficit, to bring it back into balance. Now, of course, that's not going to happen overnight, and it may never happen. But if the president did manage to eliminate the $500 billion of the current account deficit, that would also end the $500 billion coming into the country through capital inflows. And that would be $500 billion less a year to finance the U.S. budget deficit. And so with the less capital inflow coming in from abroad, that is another reason the U.S. interest rates are likely to rise. Now, already, the Trump administration has started imposing trade tariffs on China. During his campaign, he promised to impose 45% trade tariffs on Chinese goods. Well, so far, they're at 10% on $250 billion of Chinese goods. But this is scheduled to go up to 25% at the 1st of January. Now, of course, if you put 25% tariffs on imports coming into the United States, that's going to make the goods sold in Walmart very significantly higher. It's going to cause inflation in the U.S. And if the inflation rate in the U.S. goes up, then of course interest rates are going to go up. If the inflation rate moves up to 5%, no one's going to lend you money for 3%. It's going to be more like interest rates will be 7 or 8%. And that would be catastrophic for the economy. So those are the reasons I am very concerned that interest rates will move higher and cause a very severe economic downturn in the U.S. and globally.
Yeah, I mean, it's hard to argue with that. I think that all of those factors are at play. Given the fact that we have opened Pandora's box regarding the purchasing of our own debt, the printing of money, essentially the same thing, et cetera, do you think that if there is that situation where interest rates do rise, given the fact that the implications are so dire, that the Fed will step in and make significant actions to use the phrase that you used earlier, kick the can further down the road, given that strategy has already been made clear and the playbook has been outlined?
Well, yes, that would be possible so long as globalization persists. As long as globalization continues and it continues to be so deflationary, then the next time the U.S. has a significant recession, the Fed would immediately cut interest rates back to zero, and that probably wouldn't be enough.
Right.
So they would start another round of quantitative easing, and the government would borrow more and spend more, and they'd just replay the policy response that worked so well after the 2008 crisis. And they could get away with that without causing very much inflation, as they have done over the last 10 years. But that only works if globalization persists. Because if there is no globalization, if we have a trade war with China and globalization collapses, then that kind of policy response with the central bank creating a lot of money, that would then cause a great deal of inflation in the United States, just as it did back in the 1960s and 70s before we had globalization. And so if globalization breaks down through a trade war, then the Fed would not be able to save the economy again by printing money. And we could potentially be facing a 1930s style Great Depression.
Interesting. So one of the things you mentioned in that kind of discussion is that the Fed has the capacity to reduce interest rates and then further quantitative easing. So one of the things that investors are very concerned with, or anyone that's in concern with, paying attention to market timing, is looking at the spread between the 10-year and the 2-year, and basically using that as a forward-looking metric for predicting if there is a inversion of those spreads. It's usually somewhere between 6 to 24 months, somewhere in the 18 to 20 month range is typically right before a recession. But just to give listeners kind of an understanding, right now the spread between those two is about 0.29%, as opposed to about 2.4% in 2014 or so. Now, the interesting thing about this conversation, how it ties back into the Fed reducing rates down to zero or so, is that when you look at the history of that metric, historically speaking, that inversion has taken place when the federal funds rate has been somewhere between 5.5% and 15% in 1981. So in the sense of the signal for an oncoming recession, the federal funds rate is usually between 5.5 and 15%. And right now, we're very, very, very much below that. We're less than half of the lowest it's ever been as far as the data that I saw. So I was wondering if you could explain why that is significant, and also what you anticipate happening, given the fact that, the phrase that is frequently used is that the Fed may have run out of bullets, in the sense that if we have a recession right now, the interest rates, the federal fund rates, are basically the same that they were in the height of the Great Depression, which you referenced earlier.
Right. Well, so I'm not too terribly concerned about an inversion of the yield curve and what that would mean, or the fact that the 10-year government bond yield now is much lower than it normally is when the yield curve inverts. The reason the 10-year government bond yield is so low is simply because so much money has been created over the last decade and even over the last couple of decades. The central banks since 2008, through quantitative easing in the US, Europe, Japan, and the UK, they have created $13 trillion of new money. And so interest rates are just the cost of renting money. It's all about the supply and demand for money. They have created so much money that the cost of borrowing money is much lower than it used to be in the past. And so that's why the interest rates are lower than they typically been historically when the yield curve inverts. So I'm not too focused on the potential inversion of the yield curve as a horrible warning sign. The horrible warning sign is the 10-year bond yield itself, which is already moving higher. If the 10-year bond yield keeps moving higher, then regardless of what the federal funds rate does, we're going to have an economic crisis. And here's why. Credit growth for many decades now has been the main driver of economic growth in the United States and globally. Looking back to 1952, in fact, any time that total credit or total debt, which are the same number, any time that total credit has grown by less than 2% adjusted for inflation, the U.S. has gone into recession. Let me repeat that. Anytime credit grows by less than 2% in a year, this is adjusted for inflation, the U.S. has gone into recession. That happened 9 times between 1952 and 2009. Now, so if, in other words, our economy needs credit growth to create economic growth. And if we don't have credit growth, we have a recession. And if we have a contraction of credit, we have a depression. So if interest rates go higher, credit is going to contract. Now, secondly, asset prices. Because interest rates have been so low and because of quantitative easing, asset prices have been pushed to a very unusually high level. There's one metric that I look at. I call it the wealth to income ratio. What it actually is the household net worth in the United States. In other words, all the assets of the Americans minus all of their debt. That's now $107 trillion. It's up something like 50% since the crisis, something like 50% above where it was in 2007 at the peak. That's been pushed up because of low interest rates and quantitative easing. Now, my metric, this wealth to income ratio, it's that figure, $107 trillion household sector net worth, divided by disposable personal income. So income, that's the income. Net worth is the wealth. So this is a wealth to income ratio. Right now, it has never been higher than it is now. This wealth to income ratio, going back to 1952, has averaged 540%. That's the average since 1952. At the time of the NASDAQ bubble, this ratio went up to 614%. And then that was the all-time high up until then. That popped. We had the recession after the NASDAQ bubble. Then in 2007, it reflated back up to 660%. So at the peak in 2007, it was 660%. Then, of course, that bubble popped and it went back to its average level. Well, now, as a result of QE and very low interest rates, it's risen to 690%. So it is far higher than it has ever been before. And it's higher because interest rates are lower. If interest rates move up, then these asset prices are going to move down very sharply. If it moves back to its average of 540%, it's literally going to destroy tens of trillions of dollars of wealth in the United States alone. So that's 2 reasons to worry about higher interest rates. Higher interest rates would cause credit to contract, causing a severe recession, and it would also cause asset prices to crash, which would cause a negative wealth effect and less consumption and cause a second severe recession, doubly damning the U.S. economy into a recessionary or depressionary hell.
Many of the challenges that the U.S. faced, you mentioned 2007, for example, 2008, a lot of it had to do with overburdensome debt, changing interest rates to your point, and that debt being unable to be paid. And when I look at a lot of the major metrics in terms of debt, general overarching macro metrics, I'm talking about debt to GDP or household debt, for example, which is currently at all-time highs, $13.2 trillion, which is about $500 billion higher than its previous peak in 2007 or 2008. When I look at that data, it's concerning. But is there something misleading about that? Or based on that metric that you just explained, and as well as the debt figures that I'm sure you're familiar with, and some of which I just outlined, are we then therefore on the brink of a 50% asset price correction that could potentially be that significant? Are we in the brink of a 2008-like course of action? Is that kind of what you're foreseeing based on that data?
Well, so from around 1950 to around 1980, roughly, the total debt to GDP in the United States was around 150%. But after 1980, the debt started growing much more rapidly than the economy. And by 2007, it had increased from 150% of GDP to about 370% of GDP. And then at that point, there was simply the private sector had too much debt and it started to default. Credit started to contract and we started to go into a Great Depression. But the government responded. At that point, all the major sectors of the economy, the household sector, the corporate sector, the financial sector, Fannie Mae and Freddie Mac, they all started contracting their credit. They couldn't repay the credit they had already, and so their credit started contracting relative to GDP and also in absolute dollar terms. And so total credit started to contract. But the US government expanded its debt by 175% over the last 10 years, by $11 trillion. And this extraordinary expansion of US government debt kept total credit growing, and it kept the economy growing. So now the US government has something like 105% government debt to GDP, gross debt. But that is a bit misleading. If you look at the net debt, in other words, there are parts of the government that own significant amounts of government debt. For example, the Social Security Trust Fund owns a great deal of the Treasury bonds. So if you take out the debt that's actually owned by the government, the number drops from 105% gross debt to GDP down to something like 65% net debt to GDP. And then of that amount, the Fed owns $2.5 trillion. So the true level of government debt, while still very high, is not as high as it appears to be on the surface. And it's interesting, the debt that the Fed owns is essentially cost-free debt to the government. So the Fed owns $2.5 trillion of the government's gross debt is about $20 trillion. So the Fed owns 11% of the government's debt. Now, okay, the government does have to pay interest to the Fed on the government bonds that the Fed owns. But at the end of every year, the Fed takes all of its profits and gives it right back to the government. And its profits come from the interest on the government bonds that it owns. So what this means is that effectively, those government bonds that the Fed owns are not paying any interest. They are cost-free debt. As long as the Fed continues to own those bonds, the government effectively is paying 0% interest on them. And the same applies for all the other countries. So the Bank of Japan owns 40% of all Japanese government debt. That's 40% of all Japanese government debt is effectively cost-free. So this is enormously important. This means that the true level of debt that exists of all the governments in the world is much lower than it appears to be on the surface. Now, so the ability of the private sector to borrow much more can't be all that great. As you mentioned, the household sector debt is higher now, at least in dollar terms, than it was in 2007. As a percentage of GDP, it's lower. But there are limits to how much the private sector can borrow before they go bankrupt again. On the other hand, I don't see any limits in the near term as to how much money the governments can borrow. For instance, take Japan as the most extreme example. Their crisis started practically 30 years ago. The Japanese bubble blew up in 1990. And at that time, the Japanese government debt was 60% of Japan's economy, 60% of GDP. Well, now they have had very large budget deficits every year to stimulate the Japanese economy and to prevent it from going into a Great Depression. And it's worked. Japan has not had a Great Depression. If you go to Japan today, it looks extremely prosperous. Now their government debt is roughly 240% of GDP. US government debt, even at the gross level, is only 105%. Japanese government debt is 240%. It's more than double. Now, is Japan having a fiscal crisis? Are they having to borrow at very high interest rates? No, they can borrow money for 10 years at 10 basis points. Is Japan having any kind of inflationary hyperinflation? No, they're flirting with deflation. So if the governments were on the verge of having any kind of fiscal crisis, they wouldn't be able to borrow at the extremely low interest rates they can now. So, for instance, U.S. government debt, let's call it 100% of GDP. The U.S. government the GDP is $20 trillion. So that suggests the U.S. government could borrow and deficit spend another $20 trillion over the next 10 years, for instance. And still, that would only put the government debt at 200% of GDP. And that's assuming 0% GDP growth. Whereas, of course, if the government borrowed and spent that much money, the economy would grow by 5 to 10% every year, and we would never hit 200% government debt to GDP. So what I'm saying is that there is, for all intents and purposes, practically no limit as to how much money the government can borrow, as long as globalization persists and continues to be deflationary and continues to hold down interest rates. Now, if global trade completely collapses, that will be a severe inflationary shock that will take many of these options off the table. But as long as the environment we're living in now persists, there's nothing to stop the U.S. government or the other governments from borrowing much more and supporting our economies far into the future.
Yeah, I mean, so it's really fascinating. You've said a couple things that I'm very sympathetic to, some of which I'd love to have another conversation with you about, just to focus on those, but just focusing on the Japan situation, because I have been fascinated with this situation for quite some time, for a lot of reasons. Number one, I've been to Japan, which is an incredible place. To your point, it does appear that things are going quite well there. However, I frequently find myself having to play devil's advocate in the sense that for people that believe that the U.S. is in the midst of a significant risk of losing their status as a reserve currency, or that there's going to be a hyperinflationary situation involving the US dollar, I look at Japan and, very much to your point, say, there are all of the things that you can say about Japan, or all the things you can say about the United States, that Japan is much, much worse, and they do not have the status as the reserve currency. However, they do have some pretty significant challenges. I mean, I believe 40% of their workforce is not full-time. I think that they have not really experienced any significant GDP growth for basically 30 years. They have a negative population growth, which I believe has something to do with the fact that they have such negative GDP growth. I mean, there's a lot of situations. There's a baby boomer situation over there as well. But what would you do? What would you say, in regards to something like the demographic shifts that they're chasing, or facing the risks of, losing 30% of their population over the next 30 years, or whatever the figure is? It's something close to that, I know.
No, that's all correct. Because Japan's population is shrinking now, that does limit how much economic growth they will have. Of course, when the population is growing, that's very crucial in helping to generate economic growth. And the potential growth rate, the Japanese government estimates Japan's potential growth rate at most as being something slightly under 1% a year. So as long as Japan's population is shrinking, and it's likely to continue shrinking, they're not going to have significant economic growth. But of course, on a per capita basis, that's not so bad, because there are fewer people to share the wealth among. So I think Japan will be fine, even though they won't have significant economic growth. Now, as far as the U.S. losing its status as the reserve currency, what does it mean to be a reserve currency? The reason that everyone uses dollars as they do is simply because there are so many dollars outside the United States. Every year, the U.S. current account deficit is so large that it throws dollars off into the global economy. This year, the U.S. current account deficit will be something like $500 billion. So there will be an extra $500 billion in the global economy. Take China, for instance. China's trade surplus with the U.S. is more than $1 billion a day. And so China is going to receive, their manufacturers sell things in the United States, they get paid in dollars, they take those dollars back to China. So what choice does China have? If it wants to sell things to the United States, it's going to have to sell them and receive dollars. It's going to be paid in dollars. It then has the dollars. Okay, well, it could sell the dollars perhaps and buy euros, for instance, but whoever it buys the euros from, those people then have dollars. And those people are going to have to do something with those dollars, such as buy U.S. government bonds or some other dollar-denominated asset. So the reason the US dollar is the international reserve currency, simply because the US has had such a very large trade deficit now going back to the early 1980s and flooded the world with dollars. Dollars are like farmland. A farmer can sell his land, but it doesn't make the land disappear. Someone else owns it. Those dollars are out there in the global economy, and they're not going to ever go away. Someone is going to own them, and someone is going to have to use them to buy dollar-denominated assets. It doesn't matter what dollar-denominated asset these people buy, because the money is fungible. If they buy corporate bonds, it's going to push down the corporate bond yields and encourage people who would have bought corporate bonds to buy some other kind of bond, junk bonds, for instance, or stocks. The money is going to be invested in U.S. dollar-denominated assets. So the U.S. is not going to lose its status as the international reserve currency simply because there's so many dollars already out there.
Yeah, and even if they do, it takes time, but it's just kind of comparing it to Japan. So actually, I wanted to circle back, because I know that we have to wrap up, unfortunately, which I know we could go for hours on these conversations. But one of the things that you mentioned earlier is that you're not a proponent of central banks creating money. Regarding the conversation with Japan, for listeners that aren't familiar, Japan suffered basically an 80% price correction across virtually all asset classes, and they never saw something similar to what the U.S. saw during the Great Recession, or the Great Depression, I should say. So they never saw 30% unemployment. Now, I did mention that they do have different metrics and such, but generally speaking, the numbers weren't nearly as catastrophic. So how do you reconcile not being an advocate of central banks creating money, but also looking at Japan and saying they were able to avoid that, and the U.S. could double the amount of debt that it currently has, and without really struggling with problems, as long as the productivity from globalization continues? Do you view that as something that's challenging? I just want to make sure the listeners understand your perspective on whether or not the U.S. should go the route of Japan, and whether or not you think they will.
Okay, so let me clarify my views, because they're not exactly as you have put them. My first book was written in 2002, published 2003. It was called The Dollar Crisis. And the theme of the dollar crisis was that the U.S. trade deficit was so large that it was destabilizing the global economy, and it was going to lead to the worst economic downturn since the Great Depression. Okay, so it was very much based on the teachings of the Austrian school, which more or less say that credit creates an artificial boom, and that every boom ultimately busts, and there's nothing you can possibly do to prevent that from happening unless you prevent the credit from growing to start with. Okay, so that crisis did happen in 2007, 2008. The crisis I expected, it did happen. But the global economy didn't go into a Great Depression. The dollar standard didn't collapse. So we can be closed-minded about this and pretend like it's going to happen tomorrow, or we can learn the lessons from what actually did happen. And what actually did happen is the Fed created money on a multi-trillion-dollar scale, and the government borrowed $11 trillion between then and now. And those two things together prevented us from having a global Great Depression, and in fact reflated the global bubble. So I'm not opposed to the Fed creating more money in the future, or the government having increasing budget deficits if that is necessary to keep the economy out of crisis. And as I've said, I believe credit growth drives economic growth. If we don't have credit growth, then we're going to have a severe crisis. And the private sector already has so much debt that there are going to be limits as to how long they can keep borrowing. But those limits don't exist for the government sector, as we discussed. So looking at Japan, all I would say is we should learn from lessons from Japan as well. If the Japanese government had known in 1990, when their crisis started, that they were going to increase their government debt from 60% of GDP to 240% of GDP, they would have come up with a really brilliant plan on how the government should have invested that money in new industries and new technologies. Instead, what they are generally criticized as having done, they say that they built bridges to nowhere and paved the Japanese countryside with cement. In other words, just wasteful fiscal spending.
Right.
So the lesson the U.S. needs to learn is that the U.S. government is going to continue to have a very large budget deficit for the foreseeable future. We just need to learn from Japan's mistakes, not waste all of this money, government borrowing and spending, the way that the Japanese government seems to have done. The U.S. government, instead of having too much spending on consumption and on unnecessary wars, for instance, should come up with a plan on how to invest this money that they're going to spend anyway. They should invest it in new industries and new technologies, 21st century industries and technologies. that would stimulate the economy, keep us out of crisis, and they could do this on a very large scale, a large enough scale to induce a new technological revolution. The government is not investing enough. The level of fixed assets owned by the government is shrinking because the government has failed to invest enough. We need more government investment, and we need it in things like biotech, genetic engineering, nanotech, and green energies. And we have the opportunity for the government now to do that on a very aggressive scale. And it's just a question of whether they're going to do this and borrow the money and waste it on unnecessary wars and too much consumption, or whether they're going to borrow the money and invest it in new industries and technologies. They could completely restructure the US economy and lock in another American century if they just have a plan on how they're going to invest aggressively in new industries and technologies instead of wasting all the money. And the government can borrow at low interest rates, and if need be, the Fed can create money and finance some of this government borrowing, as they've done over the last 10 years. So this is a unique moment in history. It is an opportunity for government, as the last 10 years has proven, the US government can borrow and spend, well, it spent $11 trillion of deficit spending without creating high rates of inflation. And the Fed has financed about a third of that with paper money creation with no inflation to speak of at the CPI level. So this is a unique moment in history. It creates unprecedented opportunities that our country should grasp and drive our economy forward. So the Trump administration is concerned that China is going to overtake us economically and perhaps geopolitically because China is investing so much in new industries and technologies. China has a plan called Made in China 2025, in which they hope to dominate a lot of the major 21st century industries. Well, rather than starting a trade war with China and crashing their economy and also driving up US interest rates and crashing our economy and crashing the entire global economy, as would occur if China and the US both go into recession. Instead, if the US is afraid that China is investing too much and becoming too competitive, the US policy response should be to invest much more ourselves. And we should have a Made in America 2025. And we could dominate not only 2025, but 2035 and 2045 and 2055. We could invest much more than China can. And that's what we should do. But we can only do this if globalization persists. So that's how my views have evolved since my first book.
Yeah, I'm really glad I asked that because that's definitely fascinating. And while I am fascinated by the conversation, I'm very skeptical with the ability of governments to invest accurately. I think that capital would be better served through private investment, but that's an entirely different conversation, one which I hope we get to have in the future. However, before we jump off,
because after all, the government in President Kennedy in 1961 said the U.S. government would send a man to the moon by the end of the decade. And they did through very aggressive U.S. government investment in NASA. And the private sector still hasn't sent anybody to the moon.
Yes, but should they have?
Well,
should they have sent them to the moon?
Well, look at all the technology that came out of that.
Well, we don't know. We don't know if they should have used that money to send them to the moon.
Well, for instance, the whole space program was not only to send the Americans to the moon, it was to develop intercontinental ballistic missile systems so that we could cause the Soviet Union to collapse. And that worked out very well. And the spin-offs from all of that government investment, it was a major boost to technological growth. They say things like the handheld calculator came out of that program, just as a common example. Furthermore, I'm sure you have a smartphone in your pocket. Almost everything that makes your smartphone smart, from semiconductors to touchscreen technology to GPS technology, not to mention, of course, the internet itself, all of that came out of U.S. government-funded research. So to say that the government can invest successfully is just not true. And the Americans need to give that a serious rethink, because otherwise the countries who do invest at their government level are going to leave us in the dust.
Fair enough. And I really do mean that we should have a conversation specifically about that topic, because I do think that it will be very interesting to the listeners. But they will not be happy if I let you go without asking one last question, two actually, but one important one, which is regarding this conversation about interest rates and debt and et cetera. We haven't really tied it in with real estate. And I wanted to give you an opportunity to share your thoughts on the U.S. housing market and the commercial real estate market as a whole in terms of what the impact of those types of assets specifically will have in the event that we do see rising rates, et cetera, and where you think the downside is in terms of a valuation decrease.
Well, so I really am a believer in owning rental property as an investment. And what I mean is not units in a condominium somewhere. I believe the best approach is to buy a piece of land with a house on it and rent it out for rental income. And in that scenario, a lot of people, recommend gold. Okay, I think everybody should own some gold, but if you have to choose, if you have a great deal of money to invest, then I think you'll be far better off buying land with houses on top to rent out. If gold prices go up, then the land price will go up, and probably the land price will go up even more. They're not making any more land, whereas they are still digging up some more gold. And meanwhile, you have rental income on your property. So I'm a big believer in investing in rental income, as I've just described. Personally, I'm not trying to tell other people what to do. They need to ask their investment advisors. So, of course, it's always possible that the land prices will drop, but you'll still have, if land prices drop, then the price of everything else is likely going to drop as well. So relatively speaking, you'll still be relatively as well off as everyone else, and you will still have rental income. Of course, you can't borrow so much money on the mortgages that you have to be aware the rents could drop in a worst case scenario. And if they do, you don't want to have so much debt that your houses are all going to be repossessed. But I do think it makes a lot of sense for people to have a rental portfolio, if they can, as part of their significant and safe part of their investment strategy. Now, as far as the future, again, it all comes back to interest rates. If interest rates move much higher, then it's absolutely certain that property prices will fall.
Certainly, it's necessary given the fact that the majority of those purchases are debt-based, and therefore the cost of that debt is going to cause that. Now, Richard, before I want to let you go, I just want to ask one last question. Could you please give us an example? I am fascinated, particularly when it comes to Japan. I am fascinated, and I don't see enough people talking about it in the detail that you are talking about it in, which is why I'm really excited about the content that you have available on your website. Could you please just give an example or a quick reference to what that website is and the discount that's available now for the listeners of the program that have made it through this hour, which is incredibly dense. So thank you again for the listeners that have stayed tuned.
Okay, well, thank you. So I publish a video newsletter called MacroWatch. And what this is essentially me making a PowerPoint presentation every couple of weeks discussing something important that I think is going on in the global economy and how I think that's likely to impact asset prices like stocks and property, commodities, and currencies. And what I focus on is credit growth, because I believe credit growth drives economic growth. And I focus on liquidity, things like quantitative easing and quantitative tightening, because I think liquidity determines whether the asset prices move up or down. And then to do that, I have to focus on government policy, because the governments are doing their best to control credit growth and liquidity. So that's what MacroWatch is all about. I publish a new video every couple of weeks. And so I would encourage your listeners to visit my website, which is richardduncaneconomics.com, and at the very least, sign up for my free blog, or better yet, subscribe to MacroWatch. I'd like to offer a 50% subscription discount. So if you click the subscribe button, it will ask you, do you have a coupon code? If you enter the coupon code CFC, you can subscribe to MacroWatch at a 50% discount, and you will have immediate access to 47 hours of MacroWatch videos in the archives to begin watching immediately. And you'll get another video every couple of weeks. So I hope your listeners will check that out at richardduncaneconomics.com and use the coupon code CFC.
Yeah, absolutely. And just to let listeners know, I do get a little referral fee for that. And it's not something I frequently do, but I know that the content out there is going to be really compelling. So Richard, thank you again. And let's do it again in a couple months.
Okay, Hunter, it's been a pleasure talking with you. Thank you.
All right, listeners, thanks for checking out the episode. As always, the contact information for our guest will be available in the show notes page, which is hosted on SoundCloud, iTunes, and Stitcher. Don't forget, if you want access to some of the free goodies that I'm talking about at the beginning of these episodes, like free ebooks, weekly investor emails, and articles about some of the most important investment-related topics, make sure that you have created an account with CFC, because this stuff is automatically available. You can do this by going to cashflowconnections.com and signing up as an accredited investor. Of course, if you have any questions, feel free to email me at hunterthompson@cashflowconnections.com. Thanks again.